What if you could copy the investment strategy of a billionaire and use it to grow your money and protect it from crashes, inflation, and uncertainty? Because that's what Ray Dalio created. He's one of the richest hedge fund managers in the world. He created an investment strategy that is built to survive anything that the economy throws at you. It's called the all-weather portfolio, and in this video I'm going to show you how this works. I'm going to break down what the all-weather portfolio is, the pros and cons of this investment strategy, who the strategy is for, and how you can start building your own all-weather portfolio. So that by the end of this video you know exactly if this is the right strategy for you, and if yes, then everything you need to know to get started. This, by the way, is the third video in a video series about investment strategies. So if you need inspiration or simply an overview, consider subscribing if you don't want to miss the next one, and make sure to check out the other ones right after you've watched this one. Don't worry, I'll give you a reminder. If we haven't met, I'm Sophia. I've been learning about money and investing for the past decade. And on this channel, we explore the strategies of how we can build wealth without living frugal. Ray Dalio is one of the most successful investors in the world. He founded Bridgewater Associates, which now has become the largest hedge fund in the world. And it manages over $100 billion in assets, all coming from governments, billionaires, and big institutions. But what makes Ray Dalio stand out is not just his wealth, but also his philosophy and how the economy works and how he weaves that into his investment strategy. And the best part is that he made the strategy so simple, or at least simple enough that private investors like us can also use it, so that we can protect and grow our money like the pros. And now, before I dive into how this portfolio looks like, just real quick, I'm hosting a free web class where I share all the strategies that I use to build wealth while at the same time not missing out on the good life. It's live, so you can ask me any questions, and it's free, of course, so if you want to save your spot, there's a link down below. And now, what is the all-weather portfolio? The all-weather portfolio is designed to perform well in any markets. And when I say any markets, what this means is, we have different types of economic cycles. There is the bull market when the market goes well. Then there is a bear market where the market does not go so well or it goes very slow. Then we have times of inflation where our money loses value over time. And sometimes there are also times of deflation where consumer goods lose their value over time. So based on these four different economic conditions, Ray Dalio created an asset allocation that makes the portfolio go well in each of those scenarios, in each of those economic conditions. And what that means is that no matter what goes wrong in the market, at least one part of the portfolio is winning. And that at the same time is keeping it stable as a whole. So here's how it looks like. The all-weather portfolio consists of 30% stocks for growth, 40% long-term bonds for deflation, 15% intermediate bonds for stability, 7.5% gold as a hedge against inflation, and 7.5% commodities, also as a hedge against inflation and also as part of diversification. So let's look at each of the components. Stocks are for growth, and this is the part that will go well in a bull market. So when the market goes well, the all-weather portfolio will also go well because stocks are the driving force pulling it up, if that makes any sense. Now, one note on that stocks part. When you look at other sources, you may find that they mention US stocks. But as far as I know, that is not what Ray Dalio himself stated. The way I understood it is that diversification is actually pretty important to him. And not just within one asset class like stocks, but also within the whole portfolio, as you will keep seeing. And the hedge fund itself, so Bridgewater Associates, surely diversifies their stocks internationally, so not just in the US. Then we have 40% long-term bonds. And long-term bonds in this case means 20 to 30-year treasuries. And this part is what secures against deflation. Because long-term bonds are sensitive to changes in the interest rate, and therefore they protect the money in times of deflation and falling interest rates. I do want to mention, though, that there have been some interviews with Ray Dalio in the past years where he did say that bonds may not be as safe anymore as they once were or we expect them to be. And that is mainly because of today's high debt and high inflation. But I haven't heard him making changes to the all-weather portfolio because of this. So I guess the framework itself remains. Then we have intermediate bonds, and those are supposed to provide stability. And what that means is 5 to 10 year treasuries. The pro of those intermediate bonds is they do have a yield and they are not as sensitive to the interest rate as the long-term bonds. So they kind of act like a buffer during economic slowdowns and they're less volatile than long-term bonds. And the same concern here applies that we already talked about during the long-term bonds. So he did say that not just long-term bonds, but bonds in general may not be as safe anymore as, for example, during the time when he started, which was, I think, in the 60s or in the 70s. All right, then we have gold. The way Ray Dalio sees this is that gold tends to go up when the market in general and also fiat currencies, which is the currencies that we pay in our daily lives with, the dollar and the euro and the pound. So when they go down. So the role of gold in this portfolio is as a security or as a hedge against inflation, against currency devaluation, and against uncertainty. And when you do look at the price of gold at the moment, you can see that it indeed rose pretty high in the past months. If you ask me, even in the past years. I remember that I have been waiting for the price of gold to drop so that I can get in, which is exactly what we should never be doing, time the market. But anyway, so gold here acts as a security and also as a diversification through the different asset classes, right? So we have stocks, we have bonds, and now we have gold, and gold as part of a precious metal. Now, as far as I know, Ray Dalio does not insist on one specific form of gold. Bridgewater probably uses ETFs and also futures because, they're trading this at scale. But for us as individual investors, gold in a physical form would also be okay. Now, if you ask me, gold in a way is also a commodity, but it does have a, special place, or it plays a special role in economies. So here in the all-weather portfolio, commodities are a separate asset class. And those commodities can be oil, agricultural goods, or also other precious metals. But here it's the same principle as with gold. So they do act as a security against inflation. And commodities can also be bought in the form of ETFs, so exchange traded funds. Now let's talk about the pros and cons of the all-weather portfolio. The pros of the all-weather portfolio is that it is designed to perform well in all markets. And what that means is that it focuses on reducing the risk. There really is a true diversification because we have so many different asset classes represented in that portfolio. And because all of those different asset classes and because it is designed to perform well in all economic conditions, we have a very low volatility. Volatility is how high and how low the ups and downs are going to be from your portfolio. Let's say, for example, let me doodle that. Let's say, for example, we have a stocks only portfolio, or 80 or 90 or 100% stocks, then this might look like this. So obviously it will not look that evenly, but it's rather about the altitude of the curve. And then if we take the all-weather portfolio, because of all those different asset classes, it would rather go like this. So it would also go up and down, but with way less altitude. That's what a lower volatility means. All right. And an upside of that low volatility is that it makes investing less emotional. Because even if you hear on the news, the economic situation is so bad all the time, but you look into your portfolio and it's relatively stable, then you're not tempted to jump on that emotional roller coaster. Do you know what I mean? And also because it's a passive investment strategy, there is no market timing needed. So basically you would invest into all of those parts at once, and then you just rebalance once or twice a year. And the all-weather portfolio is a simplified and distilled version of what the world's largest hedge fund is doing to manage institutional money. And now let's take a look at the cons of the all-weather portfolio. So, because it is designed to perform well in all markets, it's rather a defensive strategy, and what that means is that the return is lower, especially during a bull market. So when we look at our curve again, if we have a stocks-only portfolio and we have a bull market, then we take all of that return. But because the all-weather portfolio is not at all 100% stocks, there's only 30% stocks, we don't get that return. And then, as you might have noticed, there is a heavy exposure to bonds. So we have 40% long-term bonds and 15% intermediate bonds. And the thing with bonds is that they are considered the safe investment, but in exchange for that, and that is the trade-off, we have rather low returns. And then we have gold and commodities. And even though they are considered as a security against times when the market goes down, those two asset classes, or one if you will, they do not always perform in the way we would predict them to. And another con of the all-weather portfolio may be that when you are a beginner and you start with very little money, then you still would have to start with 5 different investments in order to do it right. So this may be a complex strategy for someone who's just starting out. So now let's talk about who this all-weather portfolio is for. I would say this is a good strategy for someone who really prioritizes stability. So especially if you're someone who really has a hard time with volatility. So volatility when the stock price goes up and down and up and down, and each time it goes down, you're like, oh my God, my money, what have I done? This all-weather portfolio might just be a good strategy for you if this one ensures that you stick with it, right? And I would also say it's a good strategy for someone who wants to preserve wealth. So if you are already a millionaire, a multimillionaire, then this also might be a strategy for you, because at that time it's not so much about building wealth anymore, unless you want to, but it's more about preserving wealth. And remember, this strategy, the all-weather portfolio, is the strategy that a hedge fund uses to invest money from governments, from billionaires, from big institutions. And when you think about it, then all those people or institutions, they already have money, they already have a lot of money, and their main interest is to not lose that money. Then, of course, if you're looking for a passive investment strategy where you just set it and forget it, then this is, as by the way, all the strategies that I introduce in this investment strategy series, then this is also for you, because you buy the investments and then you hold them for the long term. All right, so who is the all-weather portfolio not for? I personally would say this is not a strategy for someone who aggressively wants to build wealth. And that, by the way, is also the reason why I do not invest in the all-weather portfolio, because of those lower returns, right? And I would even go so far to say, as even if you would like to preserve wealth rather than build wealth, and when market fluctuations do not make you that nervous, then you could also just go for bonds, but a lower part of bonds. Because here again, we have how much? 55% in bonds in this portfolio. That's a lot of bonds. So I would say it's especially the combination between preserving wealth and not wanting to see that volatility of a high stocks part portfolio. I would probably say that is the sweet spot for an all-weather portfolio. But that's just my personal opinion. In fact, if you have any experiences with this, please let me know in the comments. And now, how can you start building your own all-weather portfolio? So if you decide this investment strategy is for you, then the easiest way to build it would just be to pick ETFs. Pick ETFs for the different asset classes. For the stocks part, for example, you could go for an international index fund, but only if you insist, for a US fund. For the long-term bonds, I found the TLT. Those are I think, 20+ year treasury bonds. For the intermediate bonds, I found the IEF, which is bonds that are shorter term. For the gold part, you could go either for physical gold, that's what I personally would do, or you could also go for an ETF, for a gold ETF like the GLD. And the same goes for commodities. You can look for an ETF that has exposure to either one commodity or different commodities at the same time. And now the first reminder to save your spot in my free web class if you're interested. The link is down below. And the second reminder, if you want to watch the playlist with the other investment strategies, then I'll link that for you here. Let me know how it goes. I wish you success. If you're still here, thank you for watching this far. Subscribe if you aren't already, and I'll see you in the next video. Bye-bye.